you prefer, you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we are very lucky to have Nick Raj from the Charters and Russell Muldoon from the Montgomery Fund. Sure, it's going to be a very interesting program, especially given that we've seen such a great run for the Australian market in 2015. It's fantastic. And Russell, I mean, we're right in the middle of earnings season. Has this given you a bit more insight into how you might position your portfolio throughout the year and how the Australian market's looking?
That's an interesting question. We actually did some attribution analysis on the entire market, or the ASX 300, and we looked at the real drivers behind the share market's performance. And really, if you wanted to capture greater than half of the market's recent run, you only really need to own 5 companies, and that's the 4 big banks and Telstra. That's it. And outside of that, there's of course been some great stories like Domino's Pizza, realestate.com.au, corporate travel. There's been some very good growth stories coming through, but in general, I mean, more than half of the market's return has come from people saying, my term deposit's rolling off 12 months, it's now going 6 for 12 months, I'm now getting less than 3%. I need some more income, I'm retiring, I need some more income. So the chase for yield is absolutely insatiable.
And Russell, this is a story that's been going on for years and years, and probably not just in Australia, but all throughout the globe. We're seeing negative deposit rates over in Europe, negative interest rates in some countries, and there's massive pension funds. Australia's the 4th largest pension fund market in the world. Do you think that's what's partly driving it as well?
Oh, I think there's a significant amount of overseas investment also chasing our high dividend yield stocks. We saw an article today that, for example, China has capital outflows from its system of about $20 billion of December. Now that's the official record. Some say it could be as high as 80. Now all that money is going in, to global assets to find a better home. That could include Australia property and shares, for example. Look, the problem we're seeing, and we're still holding quite a fair bit of cash and actually have been selling into this rally, is as share prices go up, obviously there's fewer and fewer opportunities. And just take today, for example, it's been the heaviest filing day for this year's half reporting season. There was probably about 20 companies, and I've got them all in front of me here, and I've listed their revenue growth and the earnings growth for all those companies. Now, on average, of course, there's some good companies in there that have outperformed, there's some companies that have underperformed, but on average, revenue growth for those 20 companies today, and look, we're talking from port operators and Asiano all the way through to health companies in Sonic Healthcare. Revenue growth has been just 4%, whereas underlying earnings growth has been less than 2%. So, look, if that continues, PEs are expanding, but the earnings aren't expanding. So the quality of this rally is really based around that chase for yield, which I mentioned before.
But why is it not going so well?
It's a good question coming through from Tom. The Australian Leaders Fund, listed on the market, looks at investing in the top 200 companies. And I guess just having a look at their latest update on the 13th of February, they've come out with a net asset backing at $1.27. Net asset backing actually falling in a market that's very buoyant and very bullish. I think in the month of January, the market was up 3.2%, but the Australian Leaders Fund was down 1.18%. So when you see underperformance like this, Russell, do you think that's behind the decline that we've seen, or is it something else?
Look, I haven't looked at Australian Leaders Fund in great detail before, but it looks to me to be equivalent to a listed investment company where, you're right, Tom, it does have a number of investments within its portfolio. Investors will give the fund a certain pool of money for the manager to manage on their behalf. He'll then go out and buy shares that he think will be good investments for the longer term. And then that portfolio, based on the amount of investors in that fund, everyone's issued different units, but that portfolio is basically represented in its value and the change in all those shares within that fund by what you refer to as its NTA, the net tangible assets. Now, if the NTA for that fund is around $1.20, as you say, I couldn't bring it up quickly just here, then that's basically where it should trade. In a strongly rising market, you probably see the share price rally ahead of that in expectation that the NTA is going up. But if it's around $1.20, then that's where it should be priced. You'll get $1.70. I'm not sure if the NTA of the fund was overpriced that period, or if the share portfolio underneath the Australian Leaders Fund has performed poorly. Look, I'd have to dig into it more.
So $1.31 NTA after tax. Today the shares closed at $1.37.
So it's the market's going up a little bit, so the share price is a little bit ahead of its NTA. So it makes perfect sense to be trading there. And what you'd have to dig out is the reason for that decline, which is Tom's question, but I don't have time to do that right now.
Okay, until they pull back. Do you think that they will increase their dividends in the years to come? And and do they have room to grow with the competition in telcos? I mean, Telstra shares $6.58, Russell. I mean, if you thought they were expensive at $5, $6, you know, maybe all the way up to $7.
Like I said at the start of the show, though, it's just been a complete chase for yield. This business is completely detaching from any sort of intrinsic valuation that you probably could model out rationally, and it's really been priced on a yield play. The fully franked dividend in a super environment, in a tax-free super environment, is very, very attractive. Same with the banks, so it's been pushed up to a level where, you know, we can't see much value. Now, saying that, when I went through the list of stocks that have reported today and their you know, subpar revenue and underlying profit growth, you know, we've seen a cut by the RBA, 25 basis points. We think we're going to get another one if the economy, especially, you know, a port operator like Asiano, to produce negative revenue growth for the first 6 months. That's a lead indicator of imports into Australia and the health of the economy. So we think, you know, there's probably a good chance of another 0.25% rate cut coming in the next 6 months. And if that holds true, then, you know, companies like Telstra are going to be very well supported. But look, we don't own it. We own a lot of other businesses within the telco space. MTU, iiNet, Big Air, we've owned TPG in the past. These are businesses that have grown their earnings consistently over the years. Because Telstra earns the same as it did 2004. About $4 billion.
Okay, so preferring the smaller end of the market.
Well, I mean, TPG is a $5-6 billion business, so
compared to Telstra.
Oh, yeah, compared to the behemoth, it's worth about 40 billion. Yeah, like, you know, sorry, 50 today.
80 billion.
80, is it? Wow.
Yeah,
you know, for a company that produces 4 billion in profits, it's on 20 times earnings for something that's not growing. You know, you can see that chase for yield happening in front of you.
What do you think about that?
Welcome to the show.
Thank you. I love the show. I just wanted to know with Seek, like it dropped down, I think it was 8.7% today. Is it a hold or a sell? And quickly, if Greek jump out of the euro, will that affect the Australian market at all?
Sure. So a couple of big questions there from Richard. Let's talk about Seek first. It did come out with its numbers. Profit was up by 64%, but the shares fell 8.7%. I guess once you strip out acquisitions, though, it's only a 9% gain. Would you still be buying Seek in this type of market?
Yeah, we still own Seek. It's a considerable holding for us, and it has been for a very long time. Look, the main reason for the negative reaction today was the volume growth in the Australian division, the Australian classifieds. The market got a little bit ahead of itself. It was forecasting around 11 to 13% growth, whereas Seek reported about 7% growth in Australia. But look, while everyone gets sort of a little bit disappointed with that result and they have to adjust their models back, such as so forth, the share price reaction today, you have to understand this business, since it listed in 2009, has added about 900% capital gain and dividend return for shareholders over that period. It's shown with its excellent management team who have run this business pretty much since inception, the Bassett's, that, you know, mergers and acquisitions and acquiring growth and acquiring #1 websites in another 20% of the world's GDP. We're talking Brazil, Mexico, we're talking Hong Kong, Bangladesh, we're talking China with Zhaofin. You know, these guys have shown an ability with some of those investments to generate, you know, up to 4 times the original investment. Now, the market, unfortunately, is becoming incredibly short-term, and a business like this who's making such significant investments in overseas assets, you've got to give the business time to see these investments through. We think it's an outstanding business. It has incredible growth prospects, you know, pretty much unparalleled in the Australian online internet e-commerce space. We think it's definitely a hold. People just need to give the business time to see these investments through. So we're happy holders.
Okay, so holding Europe. So if these negotiations fall apart, I guess negative for risk assets. What do you think?
I think it'd be a great development for Greece itself. You know, to rid itself, all it's doing at the moment is effectively transferring all its national income to pay off debt. That is a terrible situation to be in. It has to cut just to keep repaying a spiralling interest bill. You know, if they did renege on their debt, you know, I'm not saying that they're the most ethical country in the world with what they've done. But we need to give them a chance to be able to rebuild and reinvest back into their country and get growth going again. That's the only way you're going to be able to pay off debt in the long term. You need an economy that's growing, national income that's growing, and you need to be able to move forward. Look, if they do renege, I think it's great for Greece in the long term. Short term, there might be a bit of repricing of risk within the bond markets.
Russell, what about the rest of us? What does it mean
there might be a
for
bit of repricing of risk in bonds, and some of the yields out there. We're seeing companies, for example, like Nestle, with negative bond yields. It's incredible what we're seeing out there. But saying, look, if there is a bit of a hiccup, Greece is effectively the size of Queensland in terms of its economy.
That's what they said the last time round.
So we've been here before. There's a bit of volatility, and if there's volatility in good quality shares, you take that as an opportunity to buy some.
We are in the middle of reporting season, and just having a look at Challenger. Not looking too bad in terms of share price reaction, not the best reaction, but of course the market has been down today. What do you think?
We always knew this was going to be a bit of a difficult result for them. First one was the Department of Social Security pulled their care annuities out of the market. They said that Challenger effectively couldn't sell the care annuities anymore. Then they're working with the DSS on a new product. So that was one little bump in the road for them. The other one was the transition away from accumulated pensions and their tax treatment within pension phase forced a lot of financial planners, rather than recommending annuities, to recommend accumulated pensions ahead of the January 1st change. So it was a bit of a bumpy period for Challenger. Their earnings are only down about 5% though, despite all that. Now, what you have to think though, this business, I want to read something here to you. This was in the Challenger presentation today. They said, we're only 4 years into the 20-year retirement phase of Australia baby boomers, the wealthiest generation in history. Now, you have to understand the context of that. Over the next probably 10 years, there's going to be a tripling of assets moving from accumulation phase into retirement phase. We're going to move from about $50 billion a year into about $190 billion a year moving into retirement phase. Now, within that pool of funds moving into retirement phase, there's going to be a significant amount of more baby boomers who have accumulated large amounts of wealth that want to protect that wealth and have a steady income. Now, Challenger meets that need with their annuity products. So that market, within that, it's growing from 50 billion to almost 200 billion a year, but the market for annuities within that space is going to triple, quadruple within that time as well. On top of that, Challenger at the moment has 70% market share. So they're going to capture a significant amount of that growth over the next few years. Now, that's every year, 200 billion going into the market. So they're doing 1.5, 2 billion annuity sales at the moment.
Okay, so it is now time for a viewer email, and this one is on Yowie Group. Could I please get the panel's thoughts on Yowie Group? They recently announced their product will be rolled out in Walmart stores with Kinder Surprise banned in the US. Do you think that this would make it a good speculative buy? So an interesting company. They specialise in the development of consumer products designed to promote learning and understanding. Kinder Surprise is probably one of their very well-known products. Rolling out into Walmart stores, around about 1,500 stores over in the US. What do you think of this one, Russell?
Well, I don't know about you, Julia, but when I try to give my kids chocolate, the last thing they want to do is sit down and learn something. So for a confectionery company to promote learning at the same time eating chocolate, I think that's a very impressive task, and they pull it off. It's surely worth a lot more than what it's worth today. But to get an understanding of this business's potential, first thing I would try to do is see if I can get some financials on Kinder Surprise and see what success they've had in the US and their potential. Look, that would be my first protocol. I'm not sure if it's listed. I've never really looked at Yowie Group, and I've never looked at Kinder Surprise as a potential investment. So, look, I would want to understand the market potential. I see here they've got a little deal with Walmart to supply, what was it? It was 4,000 cases of 72 cases, 7 4 is 20, about 30,000 units of Yowie, so 70,000, I'm assuming, little chocolate toys. Call the company, ask for pricing, their margin on those, see if you understand what revenue they can get off that deal, and what is the potential to get more deals. Most is learned from calling the company, understanding its potential, understanding where management see the business going, and if management are capable and honest and have good contacts, and hopefully the skill can pull it off. So Look, at this stage it remains speculative. It's got a bit of cash, it's raised some money, it's winning some distribution agreements with the biggest department store, or sorry, the biggest, one of the biggest stores in businesses in US, in Walmart. I think it's saying here it does about $280 billion in sales in FY12. So you can get in there, you can get in a few other things. Tesco, for example, you know, the world probably can open up to it, but at this stage it remains pretty speculative, I think.
Okay, so Kinder Surprise is actually owned by a European company, I believe. I think it's Ferrero. Yeah. So Yowie must have some sort of intellectual property rights or to do with.
Is Ferrero listed?
Choice.
Do you
Yes.
know? It is.
I think so.
It's Italian, isn't it?
Yeah.
Okay, well then maybe it might be broken out segmentally, so you should be able to get some numbers on it.
Okay, so that was Yowie, a smaller company. Valuations for a long time. What do you think, Russell?
What we have to understand as well is we've had a significant currency fall. So even though its earnings are only up about 10% on the half, its earnings in Australian dollar terms were up almost double that. So it's actually a very strong underlying growth when you pull it back to Aussie dollars, and that's going to continue, especially with the currency lower than what it was at the half year by about 5% already. Look, CSL had a bit of a hiccup in the first half. The market calls it a hiccup. The market, again, was forecasting a lot more growth than what the business was able to generate. A large part of that surrounded the market grew its volumes for a product called IG by about 6 to 8%, and CSL actually took a bit of market share by growing their volumes by 11%. Now, what the market got a little bit afraid of was the fact that their revenue was only up 5 or 6%. So that says they're taking market share, but they've done it by lowering their prices to take that market share. Now, what longer-term fundamental analysts would understand about CSL is IG is becoming more and more commoditised, and it's really a lead-in product now for CSL, we think, to sell other products like Hizentra and specialty products into a hospital. So look, it's a good way for CSL to get the door open for them, take a bit of market share and sell the other products, and then regain that margin later. It was just a negative surprise this time, caught a lot of people off guard. You know, it's been that business where you really hadn't had to do a lot of analysis for the last 3 years. It's been a superbly run company, still is a superbly run company. It was just the first time I had to spend, you know, pretty much a couple of days on understanding what's happening. A few other people got concerned about one of their largest competitors in Baxter flooding the market with supply growth. We dug a little bit deeper into that, and their major capacity add won't come on stream until about 2019, so that's a moot point. But we still think CSL is a fantastic business, and it's one that we hold.
Nanosonics, what do you think of this one, Russell?
I can't get over this technical issue. Look, I've had a look at Nanosonics. Nanosonics, you're right, it builds a product, disinfectant product called Trophon. Retails, I think, for about $7,000 or $8,000 a piece, and they make a lot of money on consumable products like the chemicals they use to sterilise ultrasonic probes, and they're going to expand from ultrasonic probes into a lot of other medical devices that potentially can be sterilised with Trophon. I saw them when they're out at their old manufacturing facility down near the airport in Sydney. And it was pretty clear that they'd pretty much outgrown that facility and they needed to move to a new one in order to increase production. I always thought that, you know, that would probably be the timing to start to look at it when they move to that new premises. Now, I think they're taking over Cochlear's old premises up in Lane Cove.
A lot of people hoping it's next Cochlear. What do you...
Yeah, well, if you speak to the MD, because he's one of the ex-regional head salespeople for Cochlear, so he knows that business well, and he even says, you know, people will refer to us in time as, you know, a little Cochlear. Saying that, look, the market, I think, was about 140 million in sales, and you know, when they fully penetrated, you know, they're not going to get 140 million sales for quite a long time. So we modelled it out over quite a few years, and we got to about, they probably can get to about 30 million in NPAT. Now, I think where the market is today, it's basically already factoring in all that growth. So look, unless it can expand, like I said, into other medical devices and a significant amount of other medical devices and really increase you know, those products which are used all the time and get the recurring cash flow coming through, I just think it's fully cooked here.
Sure. So having a look at Woodside Petroleum, so peaked back in September last year and it's been falling ever since. Russell, would you be picking it up at these levels?
Look, as we you know, we're talking about at the start of the show, we've really avoided commodity type investment since we began investing. So I'm not the best person to answer this one. Woodside Petroleum, I think, has pretty significant, obviously, oil and gas assets, and is a major Australian producer. So it's going to rise and fall with its production profile and, of course, commodity prices, which you probably can predict the production profile with a certain amount of accuracy, but being able to predict oil prices and what OPEC will do to the US shale oil threat, it's just unknowable. It's a big boys game. Commodity prices, they're completely unknowable what they're going to do, and you've seen that with the oil price come down from $100 to 40 or 50 in the space of a few months. So look, we prefer businesses that can control their prices. CSL was one of them. Seek increased their prices by 7%, and people had to take that price rise. We prefer businesses that can control their destiny to some degree. Sure, they're exposed to the economy, but look, it's just too hard. Look, one thing you probably could watch is, it's called OOOOO. It's a beta shares and actually tracks the crude oil price. So if you see that ticking back up, that might be a good indicator for Woodside to maybe have a bit of a rise in the future. But you're really punting on oil prices and gas prices, and I have no value to that.
We have through email. Can you please explain why G8 Education and Bendigo and Adelaide dropped in price after a fantastic report? Russell?
Look, on G8, I think what we're seeing a lot of competition come into that market. Think education, for example, Affinity Education. Gem pretty much had its own the run of the acquisitions. It's a roll-up of child education groups, obviously, and it had a clear run for a good 4 to 5 years there, and it was able to buy these things on what they were claiming to be 4 times EBIT. With competition for acquisitions and more capital chasing a finite number of centres that can be acquired, obviously those multiples go up as those centres get approached by more and more people, and they realise they can get higher prices for that. So I think return on investment is falling, and that it's falling from being a star stock and having no competition to having competition. With Bendigo, the result for the banks, and we saw ANZ today and we saw Bendigo the other day, results are a little bit soft. The underlying EPS growth has been flat to around 3 or 4%, where the market has been pricing in significant growth. One tailwind for the regionals is that the FSI recommended a levelling of the playing field between the Big Four and the regionals. I think that opens a door for significant margin improvement for the regionals and an opportunity to really increase their return on equity on their capital base. So look, Bendigo I prefer over the Big Four at the moment.
Okay, and we have time for today. Thanks so much to our guests, Nick Radz from the Charters and also Russell Muldoon from the Montgomery Fund, and for all your calls and your emails tonight. Until next time, I'm Julia Lee from Bell Direct. Have a great night.